Hey, welcome back, everyone. It is time for another red-hot covered call video. Hey, look, I haven't been behind the mic in a couple weeks, and I do appreciate you still hanging around. We have so much happening in life, so much happening in the stock market. Man, time flies. But hey, look, I have made multiple trades, and we're going to talk about them here. In fact, we're going to talk about 3 trades today. So look, this video is going to go a bit longer than my usual 12 to 13 minute runtime, but it's not going to be that long. Look, right now in this market, we need that fresh, red hot, new YouTube cover call video to jack us up, keep us motivated, if anything, give us hope in this falling stock market. And that's what I'm here to do. I'm here to motivate, inspire, show you my trades, we talk about them, and maybe you learn something. That's what we do here. And let me say this, if you do not understand that, and you do not like how I try to motivate and I try to inspire and I try to give hope to those folks out there that want to learn sometimes confusing, sometimes overwhelming strategy, just go search YouTube for that other relevant and timely covered call video that helps you up your game. Yeah, that's right. They're not out there. Okay. So look, that's what I do here. I try to motivate. I try to inspire, but more importantly, I show you my trades. We talk about them. So I hope you learn something. And for those newbies out there that really want to get into the game, I really take it to heart that you tell me that you listen to my videos, you learn something, and you actually go out and do it. Because this is about action here. This is not about sitting on the sidelines and watching other people have success. It's about you being motivated, you being inspired to the point where you want to do it. So you could be telling your success story. So look, if you like what we're doing here at the channel, all I ask you to do is subscribe to the channel. It's right there. And hey, look, if you like this video today, I want you to bang that like button because it lets me know you like what I'm doing. And what we're doing is this. I'm going to show you 3 trades today about how you can trade covered calls like a pro. Now look, you're probably thinking, that's clickbait. He ain't going to teach me how to trade like a pro. But I actually am. See, I've told you from the jump that this is not rocket science. You don't need to pay some guru $50 a month for some PDF file. You don't need to pay websites $100, $200, $300. All you need is your financial education, your experience, and then you too can be a pro. But today we're going to dig in how I've made 3 recent trades. And quite frankly, when I sat back and thought about it, if you can understand these 3 trades, what I'm about to explain to you, you are a pro. Now, that's a big word, right? Because a lot of times we think, hey, look, to be a professional, I can't be a part of that, right? I'm not a pro. Somebody is at a professional level. They always win. They always make money. That's not true. I'm going to explain to you what a pro is. Now, look, I hope that interests you. If anything, I think you'll see me do some trades. You'll hear me talk about them, and I think you'll learn something. If anything, I'm here to motivate you, get you excited, and maybe you'll go out and watch a couple more of my videos. Before we get there, I want to make a mention of a couple things before we get going. Look, if you haven't gone to my website, CTP Dashboard, and downloaded your free copy of the CTP Dashboard, I want you to go there. It's free. I don't ask for nothing. I don't charge you nothing. I upload it with over 100 of the best trading stocks right now. And I include all those research jump links that help me up my game. And that's why I do the dashboard. Because for me, it's not about somebody just giving me a list and then I go out willy-nilly and just buy them. No, I want to see the list. I want to do my research. Hey, I want to take ownership of it because that's my money on the line, right? Well, that's what I do with the CTP dashboard. I offer it up to you for free. And all you have to do is click that link. Now, another thing is, if you haven't gone to Facebook and joined our Facebook page, that's where we're doing the off YouTube discussion. Just go to Facebook, search CTP Dashboard, and click like. I'd love to have you there. I love getting the positive feedback. And finally, before we get to those 3 trades, look at this. My man Jerry set the goal of $50,000 this year. And quite frankly, I thought that was overreaching. Yeah, I made $39,000 cash on cash last year, and that just blew my mind, right? 18% writing covered calls annually. I mean, look, that got the juices flowing to see if I can do this again. So Jerry set up that $50,000 goal for me, and sure enough, with not much heavy lifting, I was able to achieve $50,000 with my last trade. Now that's 22.2% cash on cash, and we're not even done. Right now I have $3,200 on the books, and I'm only using 3 of my stocks. Typically use 6 or 7. Even though the stock market's tanking, there is opportunity here to potentially get to $55,000. But look, I'll take this and feel comfortable that I'm learning that skill that we always talk about, where I can generate extra income in retirement, living the good life, or just paying the bills, right? And I'll tell you, that is a wonderful feeling, man. Taking ownership of that and doing it just jacks me up. And it really jacks me up that I'm helping some of you out there with all your success stories that you send me. Let's go ahead and get to those 3 trades on how I'm going to show you how to trade like a pro. Trading covered calls and cash secure puts like a pro. Now, why do I think I can teach you to trade like a pro? Tell you why. Because I've had experience. I've had over 400 and 500 trades over the past 2.5 years. And what I've noticed is this. If you're really going to use this strategy to, 1, write covered calls and sell cash secure puts with the idea that you won't have your shares taken away, then you're going to have to learn some of these fundamental things that you need to do. And quite frankly, pros use them all the time. That is one of the biggest fears when it comes to writing covered calls. Even myself was fearful of having my shares taken away years ago because I thought that was a bad thing. But then I realized if I had my shares taken away, it was a good thing. Well, the problem is a lot of people don't want to have their shares taken away because they don't want the tax implication. You know, somebody might be writing a covered call on a company like Southern Company and they have owned them for 10 years and they have 100% gain in the stock. They want to write covered calls on that great, comfortable, safe stock that they've owned for years, but they really don't want their shares taken away. Well, I'm going to show you with this Southern Company trade how you can still write covered calls using those same stocks, but you have to have that experience, you know, that fine-tuned experience so you can alleviate your obligation to keep your shares and then maybe to continue writing covered calls, making even more money. And we're going to start off with Southern Company. What are the key things that you need to know to be a pro? Well, first of all, I'm going to assume that you already know the covered call strategy. Look, we own at least 100 shares of stock, an optionable stock. And what we're going to do is we're going to give somebody the right, but not the obligation, to take our shares away from us. We're going to pick a price that we want our shares taken away. We're going to pick a time frame for which we're going to give them to make that decision. And they're going to pay us a per share premium for which we call our cash printing machine, or that guaranteed monthly income I always talk about. And we're going to do this. And look, forget about why somebody would want to pay us a premium to buy our shares from us higher. That's not the point here. Point is, those are the fundamentals of writing a covered call. And if we're going to use our favorite stocks that we've owned for a long time and we do not want our shares taken away for whatever reason, maybe it's a tax reason or you just don't want your shares taken away, we need to learn how to alleviate that obligation. I call it buying back that option, taking the obligation away from that person, allowing me to keep my shares, keep my premium, and it's something I do all the time. Now, this Southern trade that I'm going to talk about right now encompasses a lot of that. And it uses one of my favorite utility stocks. 2, I use it to dividend collect, meaning I buy Southern Company for the long-term hold. And what I'm looking to do is to collect that 5% dividend income, so I hold it. I hold it for the ups and the downs. I'm not going to sell it. I'm just going to hold it. It's just a part of my long-term buy and hold portfolio while I collect that dividend. Well, the one thing I learned, and I actually like, is that I like to write covered calls on a stock like Southern, collecting that tiny little premium, right? They don't pay much premium because there's not much volatility. But what I like to do is sell that deep out of the money covered call for that little tiny premium. I feel like when I do that 4 and 5 times a year, feel like I'm doubling my dividends. It keeps me in the game and it keeps me excited. Hey, look, whatever motivates you, right? At the end of my videos, I have a hashtag, whatever motivates. The reason for that is whatever motivates you to keep you in the game, whatever excites you. So that's what excites me. So what I'm going to do is I'm going to use a stock like Southern, and I'm going to be able to collect the dividend while I write that deep out of the money covered call. And chances are I'm probably going to buy that obligation back so I could then hold my shares and probably look to write the next covered call. So that's what I did recently with Southern. So looking at Southern's 2-year chart, The one thing that jumps out at me is this. Southern will run up, peel off, run up, peel off. Now, of course, based on news and maybe interest rate hikes, because remember, interest rates are big for utility companies because they sell a lot of debt and interest rates really affect their debt obligation. So when the Fed raises interest rates, a lot of times it could hit utilities pretty hard. But for the most part, utilities are going to trade in this nice ebb and flow pattern. As the stock starts to move higher, sort of in that flight to quality in bad times like this, Wall Street will buy up the utilities, figuring it's a flight to quality. They're collecting the dividend. It's a safe place to put the money. So we get Southern Company moving in these ebbs and flows. So as I like to find that spot where I think it's not going to go above a certain number. When Southern was trading back here, I went ahead and wrote a deep out of the money covered call with a 47 strike. Now, I only gave him 30 days to make this decision. So this is going to be a nice tight trade. And I feel like Southern's not just not going to jump off the charts, right? So there's a couple things to take note. One, I own the shares. I'm going to write this deep out of the money covered. Granted, I'm only getting a 25-cent premium, but I do this multiple times throughout the year. Throughout the year, I feel like I'm doubling my dividends. So it's getting me excited. I'm going to go ahead and do it. Notice here, when I write this covered call, what do we have right there? We have a dividend. So that means I'm going to own the stock through the X date, collecting the dividend. And if by chance Southern were to jump off the chart and get away from me up here, at least I collected a dividend, I get my $47 and we move on. But what I'm going to do is I'm going to play these ebbs and flows. And what I think is going to happen is Southern is not going to hit 47. It's going to fall. I'm going to be able to keep my shares, keep that premium, keep that dividend, and we're going to keep doing it again. Actually, it's happened throughout the year. I've written 3 covered calls on Southern in between their ex-dividend date. So for me, it's exciting, keeps me motivated. And in this case, it got exciting because on this last trade with Southern, sure enough, Southern goes above 47. Do you see it above 47 right there? Well, it was getting close to my expiration date, and I had to make a decision. Do I want to keep my Southern shares? Because now the stock is trading above my strike price of 47, meaning that person who bought my covered call, he's going to take my shares from me at 47. Most people say, John, that's a great profit. From 44X to 47, dividend, premium, man, you're knocking it down. Well, in this case, I don't want my shares taken away. So I looked at buying this option back. And that's exactly what I did. I bought this obligation back. I added to my cost basis, but I was able to keep my shares and we wrote another covered call. Let me break down this important part right here because this is where if you understand this, you are damn near close to being a pro. Let's break this down. So when the stock was trading at 44X and I wrote that 47 deep out of the money covered call, I got paid 25 cents. Again, thinking it was never going to get to 47. Sure enough, what happens? It goes to 47. As we were getting into the final week, and as you know, time decay happens right here, big time. The options time value portion started to decay rapidly. So what we have is we have a stock trading at 47.70 and the option for which I got paid 25 cents is now trading at 80 cents. Now, let's understand that. We have a stock that's trading at 47.70. The option is trading at 80 cents. Well, an option has 2 portions. It has time value and real money. So with the stock trading at 47.70 and the option is now at 80 cents, do you see where 70 cents of the 80 cents is real money? Okay, so at this point, if I buy it back for 80 cents, adding to my cost basis, I alleviate the obligation, I own a stock for which is trading at 47.70. And if I sell it at 47.70, I'm actually going to get 47.70. But we have to do the math. I'm going to pay 80 cents to alleviate the obligation, remembering I got paid 25 cents. So when we subtract what I pay and what I got paid, I end up with a debit of 55 cents. And that is adding to my cost basis. So in this case, I'm going to add to my cost basis to alleviate the obligation, meaning that person cannot take my shares at 47. And that's exactly what I did. So I went ahead, added to my cost basis. I took the obligation off the board. I owned Southern shares with the idea that I would write another covered call, maybe a 49 deep out of the money covered call, collecting another 25 cents. And we keep doing this time and time again. Well, that's exactly what I did. And in this case, it's actually paying off. Southern might not get to 49, but I'm going to collect that little premium. I'm going to collect that dividend, and I have a stock that's trading way above above my original purchase price of 44X. So what we've done there is multiple things, right? We wrote a covered call, we collected a dividend, we bought the option back, we added to our cost basis, we then wrote another covered call. I mean, there's so much right there in this utility stock. That alone, most of the gurus would say that's an advanced trade. So if that confused you, go ahead and go back and listen to it again. I think the important thing here is to understand that if you don't understand what writing a covered call means or what makes up an option price, those are important things you need to know here. Because if you don't understand that an option price has real money and time value as a part of its price, you're definitely confused right now. I know, because I was you 2.5 years ago. Go back, listen to it again. I think when you break it down, you'll see that process sounded complicated. It sounded overwhelming, but I'm telling you, it actually wasn't. And you're going to do this kind of trade all the time. And it's going to flow like water once you learn how to do it. Let's go to my next trade, Chevron, where I do an in-the-money covered call. I think this is going to become a 2-part, maybe even a 3-part series. How you can become so comfortable using this strategy, you become a pro. That's why I want you to hit the subscribe button, because I am going to be doing 2 more videos on this topic of how we can become pros using this strategy. But more importantly, it's not about being a pro, it's about being comfortable. And when we're comfortable, we're confident. And when we're confident, we make good decisions. And that's one of my themes, always making good decisions. Now, here's the decision I made with Chevron, and I love this trade. Now, if you've been watching my videos, you know I love to use Chevron for range trade. Now, what does that mean? Chevron usually trades in this range, right? It's usually pretty bankable. As it sells off, they run it higher, and as they sell it off, they run it higher. This is a huge bellwether oil company that has a huge dividend, so Wall Street loves to use them. They love to trade them. Well, I do too, because I love collecting that dividend, buying the stock, selling that 30-day covered call, writing that 30-day covered call, and collecting that dividend, that $1.12 dividend. So for me, it's like double dipping my profits on a 30-day trade. Recently, what I've done with Chevron is this. I've actually owned Chevron for a little bit now. I've written a couple covered calls. And recently, when the stock has really tailed off, for which my last covered call, I bought that option back, alleviating the obligation, I went ahead and wrote another covered call right before the X date so I can hold the shares through the dividend, through the X dividend date, all the while collecting a juicy premium for an in-the-money covered call. Now, why did I do that? Okay, so Chevron is trading at about 118x. Now, I've written a couple covered calls on it, so my cost basis is about 116x. So for me, if I have my shares taken away at 117 when the stock is trading at 118.50 and I can get $4 for that, and that's exactly what I did. I wrote the 30-day covered call, a 117 strike when the stock is trading at 118.50. I got $4 for it, and I figured, look, if Chevron's going to go higher, then this is a great trade because I'll have my shares taken away from me at 117, meaning I get 117 plus the $4 somebody paid me. That's 121 for my shares. Plus, I collect the dividend, and the dividend is $1.12. So I'm pocketing $5.12 for this 30-day trade. And I'm telling you what, on a cash-on-cash percentage basis, that is a heck of a trade. Well, that's what I did. When the stock is trading at 118.50, I wrote that 117 for $4. And as the stock's heading higher, I'm thinking, okay, I'm going to have my shares taken away. Not a problem. I make 121 on the total trade plus the dividend. Well, look what happened. Oil is actually tailing off. And as oil tails off, so does Chevron. And now Chevron's trading at 116x. And I'm in a spot now where I have that downside protection, right? I sold a 117, meaning somebody can take my shares away from me at 117, and they paid me $4 for that. So as the stock sells below 117, I have $4 in my wallet of downside protection, right? I have 4 points in my pocket as Chevron falls from 117 down to 113. Once the stock gets below 113, I actually start to lose money. Well, that's how I played this trade. Now, what was my goal for this trade? My goal for this trade was to have the shares go above 121, that person take my shares, I collect the dividend because I held the stock through the X date. Now, what are the expectations now? with the stock market falling and Chevron now trading at 116, this option is trading for about $1.90. So what I can do here is this. I can alleviate the obligation by paying $1.90. Remember, I got $4. So I keep the difference in my wallet. I got $4. I pay $1.90 to alleviate the obligation. I keep my shares. I keep the difference. I keep the dividend. Now we look to wait for the markets to settle. And if we get a green day on Chevron, we might look to sell the next out of the money covered call, making even more profits. That's what I do. And I know if you can learn how to do this, you too will have this same success. So again, the key components here for this trade is that when the stock was trading at 118.50 with an X date 1 week away, I wrote that 30-day covered call so I would hold the stock through the X date collecting that $1.12. Then if the stock were to go higher to 121, I can make the decision to either buy the option back and do it again, or if the stock were to fall and go lower, I would be able to buy the option back, pocketing the difference, doing it again, or maybe the trade just expires worthless. I keep the shares and I look to do it again and I don't have to buy it back. This trade has multiple facets to it where if you can understand what I've done here, man, you're getting closer and I know you're feeling more confident with this trade. Now let's go to that final trade where we're going to use volatility to pick up some quick cash secure put profits. Okay, we're going to use Adobe here. Recently I've used Adobe for multiple market volatility cash secure put trades, and I've made a lot of money on Adobe. But I feel comfortable with Adobe. One thing I haven't mentioned through this whole process is that if we're going to write covered calls on stocks we own, we have to own the stock. So that means we have to take on the risk of owning that stock. Now, using a cash secured put, the idea here is that we're going to offer up the money to buy somebody's shares at a price we pick for a time frame that we pick, and they're going to pay us for that insurance, right? There's a person somewhere in the greater stock market that has to sell their shares at a certain price, right? They own Adobe at $250, and if it were to fall to $240, they have to sell it at $240. So what they look to do is to find a guy like me that's going to sell a cash secured put, meaning I'll put the money up front to buy their shares at that $240 mark. Now they're going to pay me for that, and they have a time frame to make that decision. But see, I make that decision. See, it's my money I'm risking. So I better be using stocks that I want to own. And in this case, Adobe is one that I want to own. I've used market volatility to the downside to write some cash secured puts to pick up some great profits in the short term. Now I'm going to explain this, but I'm telling you now, you want to come back for my next two videos because I'm going to explain this even in more detail because I get more feedback about this than most in my inbox. People want to collect that quick cash using either the covered call or the cash secured put, but they want to use the market volatility. Why? We're in very volatile times. And right now, I actually have an Adobe trade on the books to buy somebody's shares off them for $220. And I've given them 30 days to make that decision. They paid me $12 for that. And chances are I'm going to do a video on that in the near future. But what I'm going to show you today is a cash secured put that I did a couple weeks ago where I got paid $6 using that volatility, using an opportunity to profit in the stock market. Let's go ahead and finish this up. Notice I've been playing and watching Adobe for over a year now. And as Adobe was basing out here, we were having some big up days and some big down days. And Adobe will trade where it'll be up $15 and down $15. Well, you know as well as I do, with those huge swings in volatility, the premiums that we're going to collect per share for writing covered calls and selling cash secured puts are going to be huge. I would use that volatility to pick up the fat premium. So for me, what I like to do is I like to find that support line on the downside. I talk about this in my videos all the time. As the stock is falling, and notice that's a huge down day. What I'll do is I'll sneak in, hoping that I get that up day, pick up that $6, $7 premium in the hopes that the stock bounces off that and moves higher. Now, remember, cash secured put, I'm going to buy somebody's shares at a lower price. So if the stock is falling and it turns around and heads higher, that means the likelihood of it getting to my price for which I'll buy that person's shares is unlikely. So the option I got paid $6 is going to get smaller, right? And as it gets smaller, what am I going to do? I'm going to buy that option back, pocketing the difference. And that's exactly what happened here with Adobe. As Adobe was falling, I went ahead and found that support line that I was comfortable buying their shares at. I sold that cash secured put, gave them 30 days, and I pocketed $6 per share. I figured, look, they paid me $6. If I own Adobe lower, I'm okay with it because I want to own Adobe lower. And they paid me $6. So that reduces my cost basis if I get assigned the shares after the 30 days. But if I play this right, Adobe's actually going to get a little bounce. It's going to move higher. And because it's going to move higher, that means the $6 that I got paid is going to shrink. And sure enough, what happens? Adobe rallies higher. The $6 I got paid gets to $2 and I buy the option back. I alleviate my obligation to buy somebody's shares at a certain price, meaning I got paid $6, I paid $2, I pocket $4. And we look to do it again. And again is what I did. When Adobe fell just yesterday down 20 points, I used that opportunity to write in at the money cash secured put. When Adobe was trading at 220, I sold a cash secured put to buy somebody's shares at 220. I got paid $12 for that, and I gave them 30 days to make that decision. Well, as you could see, I thought that was a heck of a sell-off, and I'm going to take the bet that they're going to actually rally Adobe heading into next week. And sure enough, with the markets down some 600 points today, Adobe hung in there at 220, and it actually looks like it's up $2 in aftermarket. So as Adobe moves higher, that $12 premium I got paid will shrink, and I'll look to buy it back, and I'll keep the difference. And that's what we do. And we do this time and time again, making that guaranteed weekly and monthly income time after time after time. Now look, I hope you enjoyed those 3 trades, and I hope you subscribe because I do want you to come back when I do the next 2 videos. We're going to talk about how I use stocks like Microsoft to generate great weekly covered call income. We're going to talk about how I use market volatility, like I used Alibaba and Nvidia and Adobe when the market's volatile. Look, we could use the cash secured put to cherry pick some profits. And I'm telling you, you can do it. I'm doing it now. And it's building that skill that we always talk about. And it feels good when you have success. Like I always tell you, treat this like a business, have fun, get excited. More importantly, do it. Get the experience, have the success. Hey, look, if you like this video today, I want you to bang that like button and ring my bell so you get that email notification the next time I do a red hot covered call video. Hey, look, until next time, I hope all your covered calls are profitable.
All I see is signs, all I see is dollars.